And let's talk briefly about what makes a lower cost company work. And this is not rocket science, this is business 101. It's called competitive advantage. My company has the competitive advantage compared to most others. Now, competitive advantage means, quite simply in mortgage lending, my costs are lower. And if my costs are lower, then I can sell the product for lower. Hello, my name is Mike Florin. I'm the owner of Low Cost Mortgage. Today's your weekly update for September 19th, 2024. All right, I'm going to edit this video quite a bit, so you're going to see these little breaks in there, but that's just fine. There's a lot to cover. This video is going to be long. It is going to be long, okay? So, Fed just announced a big interest rate cut for them. It's 0.5%. It was anticipating to be a quarter, but it was actually a half. Well, rates went up, mortgage rates went up. Well, why? Or what happened, right? Everybody thinks that the Fed decreases their rates and then mortgage rates go down, but I've been doing videos on this for a little bit and I keep telling everybody the same information, which is the Fed has almost nothing to do with mortgage rates. Literally, almost nothing to do with mortgage rates. Now, what does affect mortgage rates is the stock market, the 10-year treasury, mortgage-backed securities. All of those, the same pool of money is going to go into all three of those. So for example, if the 10-year treasury is down, then more money is going to move to mortgage-backed securities, which means mortgage-backed securities go down. Now, rates went up after the Fed announced their decision for the Fed rate going down 0.5%. Well, theoretically, that means more buyers. So let's talk about supply and demand on mortgage money. Okay. We're going to get into a chart here, but first I want to cover something before we go into the charts themselves, and that is supply and demand of money. Now, if you've taken an Economics 101 course or you understand supply and demand, it's really simple. It kind of looks like this, right? It looks like a big X. And what that means is if supply, right, goes up, then the rate goes down because there's more cash than there is people that want to buy, therefore rates go down. But if demand goes up with supply of cash remaining the same, rates go up. And why is that? Well, that's because if demand goes up but cash stays the same, more people want the same amount of money, which means rates go up because there's more demand on money. So that's what you're looking at for mortgage rates. In all reality, you have to look at mortgage rates as the following. You have about 100 investors in America. It's a little bit more than that, but of the main players, we're just going to call it 100 to keep it simple. You have 100 players that are there. Banks, right? You're like Wells Fargo, Chase, Flagstar, Rocket, UWM. They're all there. And out of these banks, they're all competing for money. Now, one of the best ways to increase your input of loan applications is to reduce your rates. So if I own a company, say I own UWM or I own Rocket, and for a while they were competing with each other, and I want more loans to come into my system, I will look at where the competitors' rates are, and then I will make sure my rates are just slightly lower than it. And if I can do that, there's a higher probability that the mortgage brokers and the people in the retail space will actually send me more loans. Why? Because my rates are a little bit lower. And that's how the different companies act with each other. So you have about 100 of them. I'm going to pop up I'll pop up a chart here of investors, and any mortgage person has this. We use Loan Sifter, like most mortgage brokers do. And so anyways, you run a search, and for you realtors, you're going to see, let me pop it over here. You're going to see that we have different investors on here. You're going to see Rocket and UWM and a bunch of banks and a bunch of investors you've never heard of, a bunch of lenders you've never heard of. And they're all competing. Well, some of them have better systems than others, and some of them have worse systems than others. Some of them can go really fast with a loan, some of them cannot. But there's one universal truth, and that is if you want more loans, you lower your rates. And this is where the rates lowering or that long pressure comes from lowering rates. The competitors start to compete, rates start to come down. Why? Because we'll just use UWM and Rocket as an example. Rocket lowers their rates to bring in a little bit more business. UWM says, oh no, we'll beat that. and they lower their rates, and then Rocket comes back and lowers their rates, and then UWM comes back and lowers their rates, and then Rocket goes back, and it goes back and forth like that, right? Then something happens, negative news. Now, there's a universal truth to mortgage lending. Everyone in mortgages are skittish. They are risk averse, which means when you get a bad piece of information, you've got Rocket and UWM competing, piece of bad information comes out, they both jump right up in rate. Then they start competing again after a few days have settled out, rates start coming down, they start coming down, bad piece of information, it goes up right away. So now let's pop up this chart and let's actually look at something here. If you notice, rates come down nice and slowly. Let me move over to the side here to make it easier. Rates come down nice and slowly, and then they jump up. And then they come down nice and slowly, and then they jump up. Sometimes you'll see it jump up and jump back down again. That's bad info and then good info. But typically that rarely happens. Usually it slowly goes down, jumps up. Slowly comes down, jumps up. Okay? So that's how interest rates typically work. And if you look at mortgage rates currently, the Fed announced yesterday 0.5% decline in rates, and then what happened? Rates went up. It always happens that way. And that's because of something that I do want you guys to understand, and that is the following. The price correction, or the thought of what supply and demand of cash is going to be, is priced in before the Fed actually makes an announcement. So if you don't understand what that means, it's really quite simply like this. If you look at the last 5 months, okay? And what you're going to see is a slow downward trend in rates. Rates keep coming down, they keep coming down, they keep coming down. And it's been moving downward for 5 months. Well, that means that anybody that's actually been talking about, ooh, let's wait for the Fed decision, and then rates just went up after the Fed decision, they're kind of being disappointed because they're not actually paying attention. But it's been going down for 5 months straight, which means what? Well, the Fed makes their decision. The Fed has a very small influence on mortgage rates, but the trend is there. And it's going to keep going down slowly over time, most likely, as long as the data shows that it should be and the supply and demand of cash is there. So if demand spikes, if a lot of people start going out to try to get homes, you're going to see rates go up. If bad data comes out, you're going to see rates go up. But if good data comes out, you're going to see rates come down. And if not that many people are borrowing, you're going to see a downward pressure on rates because they're competing. And that's one of the main reasons you see rates going up and down. It comes down because investors are competing. It goes up because everybody's skittish. They're very risk averse. They see a little bit of bad information come out, and then they're going to increase their rates. And it happens pretty much across the board. So that would be a pretty good concept to understand. I think we're going to jump into rates now. All right, so now we're going to talk about interest rates for a little bit. I run a basic scenario, 780 FICO score, 400K loan amount. And so for conventional, 5% down after this last little bit of up in the rates, you're looking at, I want to say mid-ish fives. With one investor here, another investor puts it at the middle, a little higher than middle, fives. And I don't want to give an exact rate because then I have to go into details and a bunch of disclosures, but you can go to lcmloans.com/rates. But that's zero origination, zero discount, not borrower paid compensation, lender paid. Typical closing costs on a deal like that are going to be like, I don't know, 6, 7, depending on homeowner's insurance, something like that. So that's conventional. You're looking at mid-ish to mid-ish, high-ish fives, right? When we go to VA, let me look at VA here and make sure we're good. Yeah, same scenario on VA. So 100% financing, right, on a 400K loan amount. We've got one investor that 2 days ago, it was 4.99 at par, basically right at 5 at par. And then today, though, it went up about 1/8 or so, but it's giving some money back, so not quite 1/8. But then we go to our cheap investor. Let me grab my cheap investor here. So for VA with the really cheap investor, we're still in the 4s giving money back. High 4s, but still in the 4s for VA. And again, you know, higher FICO, easy file, A-paper type of thing. You know, you're right at high 4s still, even though rates went up a little bit. And then we're going to go to FHA here. Just double check here. Yep, 400K loan amount on FHA. And you're looking at really low fives with one investor, but then we're going to go to our cheap investor. Again, remember the cheap investor, we need 5 weeks on the contract and it has to be a simple file. 5 weeks. Literally, seriously, we need 5 weeks to go to the cheap investor. And the cheap investor is high fours. Isn't that great? So anyways, rates moved a little bit. They really haven't moved all that much. But again, go to lcmloans.com/rates and yeah, search out your own scenario. Now, we're in the middle of changing the pricing tool. I've got a new piece of software I'm going to integrate. It's a lot easier to use, a lot easier on the eyes, and it's going to be actually more accurate. So remember, right now, if you go to the rate search tool, you're going to see rates that are higher because I don't include the cheaper investors in there. Okay, so for example, if you run a scenario for government, right, VA or FHA, it might show you low fives because it's going to show you what I know everyone can get. But the cheap investor, which is where we send about half of our loan volume to, because half of our loans can actually use that cheaper investor, you're in high fours. So difference is low fives to high fours, right? So say 1/4% or so. So when you run your scenario, if you got an A+ paper borrower, then take 1/4% or so off the rate you see on the search tool for government. Now for conventional, typically you're going to see the one that's a little bit better, except you're not going to see Home Ready or Home Possible. In fact, let me go ahead and take this scenario and I'm going to change it to Home Ready, Home Possible. So remember, we're mid-ish fives for regular conventional. Now we're going to go Home Ready, Home Possible. And now we are below the mid-level on the fives. We're actually, I would say that called middle lower fives. You're going to see it on that email, the interest rates themselves with that specific scenario. But yeah, that's good for rates. All right, so that's roughly where rates are as of about 1 p.m. Mountain Time today. Let's see, there's another concept I want to talk about. Let me think about it. Oh, okay. I got it, I remember. Future of rates. Now, let's look before the pandemic, right? Now, before I get into that, I do want to cover the following. Not all mortgage companies are equal. There was a Facebook argument last night with a realtor that we do an okay amount of business with. I mean, I've known him for a while. He's good. He knows what he's doing, right? And so there's other lenders that were saying, hey, there's no way your rates could be that low. And it's like, yes, they can be. All right, I just re-recorded this section because I didn't want to give away too much information. All right, so there was a Facebook argument. This happens all the time with us and other lenders. A lot of loan officers that don't work for companies don't really understand the costs of doing a loan and what that cost could be. With that being said, it's really simple. If our costs here are lower than their costs there, then we can offer a lower rate and still make the same or comparable amount of money. It's really what it is. It's called efficiencies. It's called the competitive advantage. And that's what low-cost mortgage has in relation to other lenders. And this is why you see so many other loan officers say, oh, there's no way, that's not possible. How are they so low in rates? Well, it's really simple. Our cost of a loan and our pre-negotiated terms with wholesale outlets or lenders is better than what they have. And then also these other lenders that compete with us, they have a lot of markup put into their rate stack. So for example, all the headcount needs to be paid. The managers are in place and they get a % override. The sales managers, % override. The loan officer wants to make a lot of commission. Let's talk about that for a second too. What most realtors don't understand is loan officers make a lot of money. I think they make too much money. That's my personal opinion. Yours could vary. So my thought process is there's an appropriate amount of money that could be made to do a loan, because doing a loan is really not that hard. Once you understand it, once you know it, once you have the systems in place, doing loans is easy. It's just like a little machine, in, out, in, out, in, out, in, out. And the only ones that are weird, the only ones that are hard are the ones that don't fit conforming rules. Well, conforming rules are the A+ paper rules. That's the 30-year fixed type of thing. It's your income follows this rule, your debt follows this rule. So as long as they fit in the rules, it's really fast, it's really efficient, it's really easy. So for us, we focus on conforming loans. Why? Because it's fast and efficient and easy. We also focus on people that take care of business credit-wise. Now, if you're a veteran, different story. We'll help every single veteran. Why? Because I'm a veteran. And I started this company to help veterans out. But with that being said, if our efficiencies are faster and our costs are lower, then our rates are lower. It's just really what it boils down to. All right, so yeah, so all the other loan officers out there that think that it's not possible, just call me. We'll talk. I'll show you what we offer, how we do it, and there you go. Now, to prove that it worked really well, or my model works really good, a year ago, just over a year ago, just over a year ago, I talked to a few realtors. Now, this is last September of 2023. And there's a bunch of realtors and loan officers, and they're like, we can't sell. The rates are too high. Everything is just horrible. We can't close on a property. We can't get a buyer in. We can't get anyone to want to do anything. And they defeated themselves. It was all in their head. Well, I told them all at the end of August, going into September, it's like, look, I'm going to pay myself as a loan originator, a loan officer for the month of September. And I can guarantee you that I can make enough money in 1 month, to pay cash for a Corvette. Newer Corvette, one of the C8s, one of the new ones. So anyways, all of them said, there's no way, you can't do that. There's no way you can't do that. And I said, watch me. So September, made a few phone calls, called some realtors up that are in our network saying, hey, if you got anybody, this is what we got. You know, just basically did your typical loan officer thing. Because you got to remember, I own the company. So yeah, this is my desk. I'm watching rates. I'm doing loans. But at the same time, I got a lot of other admin tasks that I'm doing. I'm dealing with audits. So for example, different states, I don't want to say which state now, but we have a state audit going on right now. But anyways, I'm doing all of that and the loan officer thing. And yeah, last September, I made enough money in closings in 1 month for real estate commissions or loan officer commissions to pay cash for a Corvette in 1 month. And that was the month that was the hardest, or deemed to be the hardest, to close loans or close deals in the last several years. In fact, in the last probably decade or so. So here's a picture of my Corvette. Look at this thing. You can do it. It's in your head. And as a loan officer, if you don't think you can do it, or maybe you're in a system that's not helping you do it. So for example, if you're plugged into a company and they got all these bells and whistles, but their costs are so high that the rates are really high, maybe you need to think about moving. Moving here, I don't know. I'm very picky about who I bring in. I want experience. I want people. I don't want the loan officer drama of loan officers being desperate and trying to get every single deal through. No, that's not how you run a business. That's not how you keep people happy. But at the same time, we're doing things here in such a way that creates volume. So as a loan officer, or you realtors, you have a loan officer you like, but you want lower rates, have them give me a call and we'll see what we can do. All right, I want everyone to look at an MBS chart, and I'm going to keep it upright for a second. Okay, MBS chart, it's not flipped upside down. And if you see over the last 5 months that it is uptrending over time. The MBS chart, in this case, it's the 5.0 MBS. It's a 5% coupon, which means the investors that are investing in the 5% coupon, they expect to get 5% rate of return for their money. Now, if they're willing to pay out a certain amount of money to get that mortgage note at 5%, and that's why you see that payout increase over time, or change over time. In this case, it's increasing over time, and that's because it's worth more and more money to them to get a rate of return on their money of 5%. And I'm kind of simplifying it, if that makes sense. Well, now I'm going to take that chart, I'm going to flip it upside down, because this is how it's easy to read for a layman. So for me, when I'm looking at it, I'm looking at payouts on MBSs. But for everybody else, realtors and consumers and everybody else, we're going to look at what does that do for rates. And if you look at this downward trending rates over the last 5 months, because we flipped the chart upside down, it shows you very easily, nice, slow, downward, and then up right after the Fed announced their thing. All right, so why did the rates go up after the Fed announcement? Well, this is kind of the same thing that happens when the rates went down after the Fed announced that rates were going to go up, or the Fed rate would go up, a year and a half ago, a year ago. And that is what the mortgage industry anticipates is going to happen is already priced into rates before the rate announcement. You got to remember, the Fed doesn't really directly affect mortgage rates. It has an influence kind of on it in sort of way. It's kind of a very, very slight pressure. But let's look at a chart real quick. All right, this is going to be your 6 months 10-year treasury, because it just illustrates that point really well. And the rates come down and down and down slowly over time. Remember, the Fed has not moved their rate at all, but the rates are moving down and down. And before the pandemic, government was low fours. But now, right now, last week, government was, for us, high fours. So we're getting kind of close to where they were, and yet the Fed hasn't changed anything. Everybody's pricing in what they think is going to be the Fed decision. Fed decides, and then rates go back up again. And that's because all of the decisions or all of the pricing is actually already baked in before. So let's talk about the future of rates. Since before the pandemic, government was low fours, conventional was owner-occupied was mid-ish fours, and investment was low fives. And that's, again, no origination, no discount. That's just the basic, that we'll call it the par rate. Since that's roughly where things were before, where are things going to settle now since the Fed's really high? Well, it's pretty simple. Supply and demand of mortgage money is going to dictate that. So if you have a bunch of borrowers that come into the system and start trying to borrow money, it's going to put an upward pressure on rates. But if you have less people trying to borrow money and more people trying to put money somewhere where they can get a good rate of return, well, it's going to put a different pressure on rates. Now, where things are going to end up in the future, not quite sure. Are you going to see rates in the twos again? No, most likely not. That broke the economy. That broke the housing market, not the economy. It broke the housing market and created a lot of inflation. Are you going to see it in the threes? Most likely not. Now, is it possible that government could maybe go high threes at some point in the future in our lifetime? Sure. But I'm pretty sure that the players, the leaders that are dealing with all the different companies and all the supplies and demands of cash and all of the investors that are trying to get rates of return on their investor coupons, they're not really going to want rates to go back in the twos ever again. That did a lot of damage. Threes, low threes, probably not. High threes, maybe, but most likely low fours on government, mid fours on conventional, and low fives on investment. The Fed lowering the rate could be good, could be bad. It's going to come down. I mean, the Fed rate's going to come down a bit more, but at the same time, mortgage rates are independent of the Fed rate, but the Fed rate is newsworthy. The Fed rate is what borrowers actually pay attention to because the news people will talk about it. Why? Because mortgage numbers and mortgage lending is a very boring subject. Very, very boring. But regardless, what do we expect in the future? Downward trending rates. 5 months of downward trending rates. It might slow down a little bit. It might accelerate a little bit, but we know just it's going to expect it to be at least downward or relatively flat unless something really bad happens. Anyways, Mike Florin, Realtors, go out there, go sell, find some buyers, go find some properties. Have a great day. I'll talk to you guys later.